Domino's pizza stock is up almost 12% year to date. They are reporting earnings this Tuesday, and it was one of the last purchases of Warren Buffett. In this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, some important statistics, using my spreadsheet to calculate the intrinsic value of Domino's, as well as revealing whether or not I am adding it to my stock portfolio challenge. Starting with their financials, as you can see, Domino's is not a fast-growing company. Their revenue went from $3 billion 5 years ago to $4.7 billion currently. However, I will say that their revenue has grown very consistently. If we take a look at their profit, their net income has also grown pretty consistently but not very fast, and it is currently at $608 million. In terms of free cash flow, it is also very similar to net income, and it is currently at $573 million. Their margins are very solid, with profit margin being at around 12% and free cash flow margin as well, so very consistent. Another thing that I like about Domino's is the number of shares outstanding. They have been buying back shares every year consistently for the past 5 years. This is very positive for investors as you own more of the company and you will get better returns on the stock. Now, in order to take a deeper look at the valuation, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value is between $236 per share and $433 per share. So it doesn't look very good. This also means that if my low assumptions occur, you're going to get a negative 1.6% annual return on your money, middle 3.7%, and high 8.7%. So not a lot of huge returns according to my assumptions, and I think they're reasonable, as I have the company growing between 4 and 6% annually for the next 7 years, averaging a profit margin and free cash flow margin of 10, 12, and 14%. I assigned the P/E price to free cash flow at the end of the 7 years of 16, 18, and 20, and I assume they buy back 1% of their shares annually for the next 7 years, as we've seen before. If you want to get access to the spreadsheet, I'm going to leave a link in the description. And by the way, these returns include the dividend. This is a very popular stock among the dividend community because they have a dividend yield of 1.5%. The payout ratio is 37%. The payout ratio is what percentage of the net income or free cash flow goes to pay out their dividend, so it is therefore a very safe dividend. Then, if we take a look at some statistics, their balance sheet is not very good, but it's also not bad, as they have $304 million in cash and 5.2 in debt. So they have some debt, but they have a lot of leases, so I wouldn't be worried about this debt. And then looking at the valuation, the PE and forward PE is 26 and the price to free cash flow is 28. So I wouldn't say it's cheap for such a slow growing company. So finally, am I going to add it to the portfolio? The answer is no, because I like to buy companies that I believe are heavily discounted, such as Alibaba, PayPal, Walgreens, or SoFi. The best one performing so far is SoFi with a return of 197%. But I like Domino's Pizza, I like their fundamentals. However, the price is just too expensive for me, so I'm personally going to wait until it falls in price in order to buy it. I hope you found this video valuable. Let me know what you think about Domino stock in the comments, and I'll see you in the next one.